Narayana Health is the next management on the program. The hospital recorded an in-line set of second quarter numbers. Revenues came in healthy, but EBITDA margins contracted. International business revenue fell at 19%, largely due to a slowdown in patient volumes from Bangladesh. We have Sandhya J, Group Chief Financial Officer at Narayana Health, now joining us. Sandhya, good morning. Great to have you with us here on the program. Thanks very much for joining us, as always. I want to start with exactly that, the international business, international patient volume. Could you talk to us about that 19% drop that you saw? What is the situation in third quarter so far? What is it as a percentage of your overall numbers?
Sure. So first, let us start with the numbers. Our international business last year, same quarter, was about 8%, above 8%, 8.7% actually. That has dropped to 6.6% this year. So we've seen that kind of dip, and that's why you're seeing that 19% year-on-year drop. We haven't seen any significant improvement in terms of the international numbers. One, because there is a visa restraint that people are not able to travel. And second also is that in quarter three, even otherwise travels are not as robust as they are in other quarters. So we are anticipating that we will continue to see decline in the international business. Having said that, we've always guided that our endeavor is to be able to show growth in the domestic business. And that's where our focus has been. So to that extent, we are very happy that we've been able to report a 13.5% growth in the domestic business, which has been able to offset the impact of the losses that we've taken on the international business.
So what could be the domestic business growth, Sandhya, for the full year then?
We aren't guiding that number, but we can definitely expect in line with the performance that we have delivered so far. And improving from here.
This international patient volume drop-off happened in Q2, right? I mean, started in Q2, essentially.
It had started in Q1, but because there were already patients who had come into India, so there we were finishing off the procedures, but further travel had got reduced significantly. So therefore, the full impact we were seeing in Q2. And it is only, I don't think it's going to get better from here. At least in the short term.
Okay, all right. So we'll have to take that on board, that the international patient contribution will perhaps remain under pressure. But let's talk about the domestic business, Sandhya. Give us some color on how occupancies have been and how, whichever metric you look at, average revenue per occupied bed, or I think you look more at revenue per patient, right? I remember that conversation always. So give us some color into how revenue per patient has improved this time.
Sure. So just a little step back to the context of the domestic business. There are like two sides to that performance. One is our flagships were under some pressure in this quarter. One, of course, because of Bangladesh, we already spoke about, but also because Kolkata is a very important portion of our mix, and there was a lot of political tension in Kolkata. And therefore, that part of the business was under some amount of stress. So that's one side of the picture. The other side of the picture is the other units, which is the non-flagship units. All of them, fortunately, performed quite well. In fact, many of them hit their highest ever revenues. In fact, we ourselves as a group have hit our highest ever revenue this quarter. We've crossed 1,400 crores as a milestone. So it's like a little bit of impact from international and from the political situation in Kolkata, but also a lot of improvement in terms of the performance of the rest of the group. So that's just a broad context. In terms of our average revenue per patient, the IP ARPP, it moved to 1,35,000. It was 1,29,000 last quarter, and 1,18,000 the same quarter last year. So that's a healthy 14% YOY and close to 4% quarter-on-quarter growth. In terms of footfall, our total footfall was about 7.7 lakh patients this quarter. Again, that was almost a 9% growth quarter-on-quarter. So again, a good growth in footfall. Having said that, this has this number is moderated because of the impact on the flagships.
Just rechecking the number, your average revenue per patient stood at 1,35,000 in this quarter versus 1,29,000. That's in Q1? Or
Yes,
was it the previous
Q1.
year? In Q1. Okay, so
Of
from
this
Q1
year.
it's improved. Okay,
Yes.
okay, that gives us some sense. So Kolkata and Bangladesh lending some pressure to the business.
Indeed. Sandhya, what about your occupancy? I missed that number. Was it at 60, 65% is what we were talking about the last time around? It's in that vicinity?
Yes, we are in that same range, though our non-flagships have seen greater than 70% occupancy. So that's been a very healthy occupancy across all our non-flagships. Flagships have had a little lower occupancy.
Okay, all right. Let's focus on Cayman then. You know, your operations out there saw a decline of close to around 7%. You have commissioned a new unit as well, which in the near term could be a margin dilutive. So could you tell us how do you see that business shaping up from here on, and by when can we return back to normalcy in terms of margins profitability?
Sure. So we did see some scale down in terms of acute high care procedures because we were getting ready for the new hospital. So some of the doctors took early leave to ensure availability when the hospital goes live, etc. And also because the revenue base of Cayman is very small, so small variations bring that fluctuation. There was one more event was like that there was a shutdown for about 7 to 10 days in August because of hurricane. So we almost lost 10 days of revenue during that period. Cayman is a hurricane-prone geography. And then during that period, transportation, etc. gets severely impacted. So this resulted in a dip in revenue. But the costs were all fully loaded up because the hospital is ready for commissioning and we're going through the approval process. We've got one set of approvals as of last week, and we have to get another set of approvals, which will happen over the next few weeks. So therefore, we are also seeing the full effect of the dilution, which is coming because all the medical hiring is done and all the overhead costs are being incurred, but there is no top line coming in from the facility. So that also is impacting margins. We've always guided that we need at least 4 to 6 quarters to be able to bring back the full scale in terms of margin. Just I want to give a little color saying the underlying margin of the India business has actually grown. The overall dilution has come mainly because of Cayman and because of the investments we are making in integrated care. So that dilution impact which is coming on from Cayman will slowly taper down over the next 4 to 6 quarters.
Right. So in the near term, we should work with a margin band of around this 23 to 25%. Would it be fair?
I do not want to guide, but it sounds fair.
Okay. All right. You know, you have lined up a big capex, as you've mentioned in the past as well, of more than 1,000 crores. But the street would be interested to know about the return ratios, ROE, ROCE. Is there any target band you're looking at? You know, I was reading a couple of notes which suggested that you'll be in that vicinity of around 22 to 24%. Would that be, an aspiration?
Definitely. The only point is that a lot of our capex investments are happening in greenfield assets. So, which means that during the build-out phase, which is the next 3 years, there would be the capex coming on the books, but we will not have commensurate revenue. So, all these assets have to start delivering return to be able to hit the target ROCE band. So, there will be a period in the interim where ROCE will dilute. So as you would have already seen from Q1 or Q2 of last year to Q2 of this year, you've seen a ROCE dilution because of the investments we've made in land and the Cayman capex going fully live, etc. So that dilution we will see in the short term. But once all the assets go online and the returns start coming in, we will go back to our target ROCE.
And that is 22 to 24%.
Upwards of 20%, yes.
Okay. All right. Sandhya, we'll leave it there. Thank you very much for joining us. Appreciate you being here on the program. Good luck and speak to you again soon. By the